A guarantor home loan generally comes about because the purchaser doesn't have a very high deposit or they've got no deposit. Um, so when you're looking at that from a lender's point of view, that's very risky. So a guarantor is someone who wants to help the purchaser out and they already own a property and they say, hey, you can use my property as guarantor to the loan. Um, so that's basically how it works. Guarantor loans are sometimes called different things depending on which lender you're dealing with. So sometimes they're called family guarantors, sometimes they're called family pledge. They all mean pretty much the same thing. So with family guarantor loans, generally the guarantor has to be a relative, so either parents or a direct relative, so brother or sister or something like that. Some lenders are a bit more lenient and cast the net a bit wider, but generally it's close family. It works a little bit differently depending on which lender you go to. So most lenders will qualify the guarantor because at the end of the day they are taking quite often their family home and securing it against someone else's loan. So they make sure they do all the checks possible to avoid worst case scenario with guarantor loans, which is selling out the guarantor's property. So they'll check the guarantor, make sure they're in a position to actually be the guarantor. Yeah, if that works, all they need to do is do the standard, which is assess the buyer for the home loan. The benefits of using a guarantor are pretty straightforward. So generally when you've got a choice between going out on your own or using a guarantor, the differences are with a guarantor you don't have to save a deposit. So that's your first major one. Secondly, you don't have to pay mortgage insurance. So I've seen mortgage insurance over 20 grand. It really depends on how much deposit you've got and the value of the property. But yeah, it's a significant savings. And the other major benefit is that the interest rate is generally much cheaper. As I said, the policies and the cost value vary greatly from lender to lender, I should say. But yeah, as a general rule, you're going to save a lot more on interest rate. When I have clients and their parents or their families that enter into these sorts of loans, these family guarantor loans, the one of the major questions is when can the guarantor exit as the guarantor? So the basic rule of thumb is whenever the loan becomes 80% of the value of the property. So that is generally done in a combination of two things. Firstly, the home buyer paying the loan down, and then secondly, hopefully the property going up in value so that eventually the loan becomes 80% of the value of the property. There is one thing to watch with guarantor loans, and that is you need to be aware that if you try and remove the guarantor, the lender can reassess the home buyer to see if they can do the loan. So if the guarantor wants to come off, for example, and the home buyer or the person who owns the home now is no longer working and the bank reassess them for that loan, they're not going to agree for the guarantor to be removed. So that needs to be taken into people's considerations, because if the guarantor, for example, is looking at selling their property in a year or two, there could be some serious hurdles to doing that. So yeah, basic rule is deal with a good mortgage broker, because all the different lenders will have different scenarios where they will accept and different lending policies. So different banks are going to suit different clients depending on what their needs are. And the role of a mortgage broker is to try and figure out what those needs are and go to each bank and figure out which one suits you the best.